And finally, we're going to look at the big numbers out of the U.S. this week. So first, we're going to get the first look at fourth quarter GDP. Expectations are for a slowdown from 3.2 to 2.7% for the annualized rate. Then we're going to get on the closer of the week, the PCE index. This is the Fed's favored measure of inflation, as I mentioned earlier. The key number here, the core number, which excludes volatile items like food and energy. And we're looking at the year-on-year rate there. So the expectation from 4.7 down to 4.4%. That's the survey of economists done by Bloomberg. Let's contextualize what these numbers mean. Here's a chart of what is expected for the U.S. So you can see not really a meaningful difference. So yes, we move from 3.2 to 2.7. It's a little bit lower. It's well within the range of where growth has been. Let's call it since the beginning of last year, and most likely even longer. Let's say the beginning of 2021, as you get the recovery from COVID initially spiking, then coming back in. We're very eye-catching, by the way, to see. First, you get growth rates approaching 40% on the negative side, then on the top side, which of course is way outside anything like the norm. And these numbers are seemingly going to be relatively in line with where we've been recently. Looking at the situation with PCE, here a little bit more emphatic of a situation. We would be looking at the lowest number on headline inflation in quite some time. 4.4% would actually give us a significant pullback in inflation. To give you a sense for when the last time it was that we had numbers like this, back in late 2021, in November, we were already at 4.8. In October of that year, we were just under 4.4, and so at about 4.3 and change. And so we're looking at the lowest inflation reading in over a year when we look at those numbers. So we'll see how that inspires the Fed narrative, if it registers a bit higher or a bit lower relative to expectations, and what that ends up giving us. Now, if you look at the current situation, you can see the yield curve in the U.S. hasn't really shifted very much since the last policy announcement on December the 15th. So it doesn't really seem like there is a very active level of speculation. It looks like the markets are all but convinced as to where the Fed is going, how they're going to get there. You can see in this yield curve again, looking for a peak just between the 3 to 6 month space in the curve. So let's call it March to June or so. Looks like we're going to get to that range of 4.75 to 5% right in there, and then hold. And then rate cuts already on the menu, essentially by a year from now. So let's call it by January of 2024. That's a view that hasn't really changed in markets. It's flattened a little bit at the back end. It's steepened a little bit at the front end relative to where we were in December, but not a meaningful shift. Here too, though, there's the Fed's last meeting on December the 14th, and you can see there, looking at economic surprise indices, in this case both from Citigroup and from Bloomberg, you've seen a significant underperformance on U.S. economic data, ostensibly a little bit more aggressive of a shift there from Citi than from Bloomberg, but both of them essentially telling the same story, that U.S. economic data is really starting to underperform. Recall, there was a similar story that we saw over the summer that gave us quite a bit of dollar weakness on the expectation that the Fed might pivot. And of course, we know how that's turned out. Data turned back higher, dollar turned back higher. In this particular case, maybe we'll get more substantive surprises on the top side for economic data, or maybe we are going to get further validation, considering these things are appearing to roll over, that the global economy, led by the U.S. economy, is slowing and are starting to give us worries about a coordinated global downturn, in which case things might need to get reassessed. And with that in mind, putting it all together, looking at the situation with the PMIs and increasing contraction in the US, in the Eurozone, in the UK, with apparently collapsing inflation expectations in Canada, warning that maybe the state of the economy there is starting to roll over. Looking at the surprise indices for the US and what might show up in these PCE and GDP numbers around that, we are reminded once again that the most standout thing that occurs in those kinds of environments where the world starts to worry about the business cycle as a whole, especially in situations where the U.S. is underperforming relative to other major economies, as we're seeing in these PMI numbers. In those situations, the markets stop thinking about returns. They start thinking about the preservation of capital. They start thinking, how do I not lose what I have? Never mind making more. And so you see this shift captured by the dollar smile here. We've talked about this before, that the dollar tends to rise when the U.S. economy is doing much better than its peers or much worse, which makes it special. And the reason for this is because markets at a certain level of consternation no longer care who is going to outperform. What they care about is, where is the liquidity, where is the safest harbor to park one's money. That safe harbor is the most liquid harbor, for obvious reasons. It's much easier to move money in and out without moving the underlying asset in a significant way, which can, of course, impose losses. Secondly, more liquidity is less volatility, almost by definition. The more liquid something is, the more buyers and sellers there are. The more buyers and sellers, the smoother the price action, the more capital can be absorbed going in, going out, without creating a lot of dislocation. And so what you end up with then is U.S. bonds and the dollar tend to do best even in environments where the U.S. is underperforming and the pain is U.S.-centric for the global business cycle. Ostensibly, we're back in that kind of environment again. Fiscal stimulus was biggest in the U.S. amongst the major economies, especially as relative to the size of GDP. So inflation was the most acute. So the tightening was the most aggressive, at least so far. That's given us outsized weakness in the U.S. relative to most other major economies. This is the kind of environment whereby, as you start to confirm that indeed the Fed story is no longer the active object of speculation because the Fed and markets are basically of a mind, which is what we keep seeing in all these yield curves we've looked at, and which may well get confirmed at the Fed policy announcement next week. The next question becomes, what are the implications of all of these things? Now that we're no longer speculating on where the Fed is going immediately, we can begin to speculate on the consequences of what it's done so far. Those consequences increasingly start to point us toward a capital preservation type of market dynamic, which is precisely what you would see on the left side of the dollar smile here. A stronger dollar, not for reasons of return or capital appreciation, but for reasons of safety, of a desire for refuge amid fear. And so looking at this data this week will be very, very important in setting the stage for whether that's indeed the world that we're in, and whether in the wake of the Fed's announcement next week, it will be increasingly the world that we find ourselves in across financial markets, across assets. Because if this is the environment, then correlations lock into 1 and -1 or thereabout. The dollar and bonds move in one direction, yields, stocks, other major currencies, and the overwhelming majority of commodities move in the other, in almost perfect sync. So looking at this economic data and getting the stage setting, looking at the Bank of Canada and getting the stage setting for where the U.S. economy is, where the global economy is, and what may happen when the nail finally is in the coffin of immediate near-term Fed policy speculation, which may be as soon as early next week, mid next week, where the markets go from there, perhaps for the subsequent 6-9 months, if not longer. So very, very important economic data on the docket for this week. With that happy thought, thank you for joining Macro Money. As ever, you can find us here Monday through Thursday, starting at 4:30 Central, 5:30 Eastern, and 2:30 Pacific time here on the West Coast. Right ahead of it, overtime with our good friend Chris Vecchio for a full hour. If you'd like to hear my various crazy pronouncements and speculations in the interim, by all means come and check them out on Twitter @IliasPivac. Thanks everybody for joining Macro Money. Speak to you tomorrow. Take care.